All right, everyone. So welcome to Chapter 3 of the Warrior Pro courses and the small cap day trading course. So here we're going to get into stock selection. All right. Now, for those attending live, there's a snowstorm out, so it's not really bad right now, but there's a risk that I could lose internet. I hope that doesn't happen, but if it does, we'll resume later or tomorrow. So, but in any case, hopefully for the recording, we're able to get through a good section of the class here. So, Chapter 3 on stock selection. Now remember what we talked about, how stock selection can be a second form of risk management. Reduce our risk of unnecessary losses by focusing on trading the strongest stocks each day. So today you're going to learn a little bit about HFT, high frequency trading, stock selection certainly, high relative volume, extreme stocks, trading the big days, how we find stocks to trade, low float runners, former Momo stocks, follow through days, inside days, building a watch list of gappers, and breaking news. And this will be through the multi-part Chapter 3. Why is this important? Well, theories of trading are great, but at the end of the day, you need to be able to find stocks in real time. It's not enough to be able to watch the news at the end of the day and see, oh, these 5 stocks made huge moves today. You need to be able to find them in real time. So in order to find stocks before they make that big move, while they're halfway into the move, while they still have opportunity for profit, you need a system. And so we're going to talk about the system today that I use for finding the right stocks to trade. And we're going to continue on what we sort of laid in the foundation of the starter courses of what really qualifies as being a strong stock to trade. Now, before we get into stock selection specifically, let's just talk a little bit for a second about the role of high-frequency trading algorithms. So high-frequency trading algorithms in 2010 accounted for 60% of the total volume in the market, and I would wager that it's even higher today. These high-frequency trading algorithms run by the big financial institutions and hedge funds, they are computer systems developed by some of the most brilliant minds in the industry, and they're designed to run all by themselves and to generate profit from the market. Sounds pretty cool, right? And I'm sure all of us would love to be running a high-frequency trading algorithm that printed money every single day of the week, but ultimately none of us are going to be able to do that for a number of reasons. The first is we have commissions, which you don't have when you are the broker, when you are the fund. The second is economy of scale. What they can do with multi-million-dollar, billion-dollar portfolios would never be realistic for us to do with really small size. And then from an intelligence standpoint, not to shoot anyone down here, but ultimately, if you actually created an algorithm that was successful, it would be competing against algorithms that are actively developed and maintained by some of the smartest minds in the industry. So let's be realistic and admit that none of us probably stand a chance. So we're not going to try to develop high-frequency trading algorithms. We're not going to try to do any robo-trading or try to somehow automate trading. Sometimes the drive to do that comes from a place of wanting to avoid losses and wanting to just make money without having to do the work. That's, listen, guys, only the big hedge funds are allowed to do that, not us little guys. So we have to actually get in there and do the trading. And of course they do too. I'm giving them a hard time, but ultimately they spend a lot of money, to maintain those systems. It doesn't come without a cost. So rather than trying to find the holy grail algorithm or high frequency trading program or robo trading program that will just make money and print money, we have to actually go out every single day and try to find strong stocks to trade and understand where to get in and where to get out. So I would argue that if 60%, let's just say, of trading volume, maybe 75% now, who knows, whatever percentage it is, inevitably it'll be higher on some stocks and lower on others. And so if we just look for a moment here at Sirius Satellite Radio, this is a stock that I would say generally, because it trades in such a narrow range and doesn't really move that much, is going to have a much higher level of high frequency trading algorithms, and something like GameStop, which has been a big topic for us from last week and will be this week as well, This one would relatively be much lower. This one's got a lot more retail traders jumping in, jumping out, and trying to get their piece of the action. So I would identify a safer place in the market for us to be trading as on a stock or financial instrument that has lower levels of high frequency trading and higher levels of retail trading. So a retail trader's market. As retail traders, we are competing against HFTs, billionaire hedge fund managers, institutional traders. And here's the thing. Big money will look for different opportunities in the market than what we're going to look for. The stocks that move 20 to 30% in one day, or maybe 100, 200% in one day, generally, those are going to be too volatile for a 100 million, 500 million, billion-dollar hedge fund. Usually, they're going to be looking for safer places in the market. Now, there will be times where, as we've seen with GME, a hedge fund does get itself focused on a stock that does have a lower float of only, in the case of GME, about 50 million shares. And as a result of trading GME, the news out right now is that one firm lost, I believe, $6 billion on the squeeze from 15 up to 300. And total losses to the short side due to the short interest are totaling at just about $20 billion. So these typically would be far too risky for a hedge fund to trade. And therefore, they would focus on stocks that have higher floats, larger market caps, and much higher daily volume. More likely to be stocks trading in the S&P 500. And so for that reason, I usually leave those stocks to the big guys. I don't usually try to focus on day trading Facebook or Apple or General Electric or General Motors or Tesla. Not that you can't day trade them from time to time, and not that they don't occasionally provide some opportunities on maybe a day that they do have news and high relative volume. But in general, most retail traders prefer lower price stocks because most retail traders have smaller accounts. Even if smaller even if smaller is 100,000, that's still much smaller than your average hedge fund. So usually you will find the stocks with floats of under 50 million shares and the stocks trading under 20 and certainly under 10 to be the ones that are more popular on any given day. So when it comes to stock selection, our job is to try to find those one or two stocks each day that are bucking the trend of the overall market. That while the market perhaps is sideways, that these stocks are making big moves to the upside. And of course, what we will continue to talk about is the importance of high relative volume and the catalyst which brings in that volume. So from a stock selection standpoint, we're going to be talking about float, relative volume, volume spiking at or around the time of entry, ideally a strong daily chart with a price above the 200 EMA and no nearby resistance. So we want to see those gaps and windows on the daily chart. Ideally, some type of news catalyst driving the momentum, but a technical breakout can work. And we always like to trade former momentum stocks with a history of making big moves, although it's worth noting that on the first day a former momentum stock made the big move, it wasn't a former momentum stock. It was just a regular old stock that all of a sudden made a crazy big move. And then from that point forward, people look at it as having, had this history in the past. So usually the type of stocks that do that are stocks that are pretty under the radar, that no one's really been focusing on, that have very low volume on a daily basis. So stocks that have maybe 5, 10, 15,000 shares of volume on a daily basis with a float of under 10 million shares that all of a sudden have great news that comes out and are gapping up 40%. And then on that news, rip up 80, 90, 100, 200, 300%. And because the average volume has been so low, there aren't lots of traders who have been holding it for a long time, who already have sell orders lined up to take profit. You really don't have a lot of probably bag holders. So all you have really initially are people just jumping in, riding that surge of initial momentum. So it can sometimes be those no-name random stocks that create the biggest moves, and they're not former runners at the time that they make that move, but they will almost certainly have a catalyst. They will certainly have volume spiking at the entry. They will certainly have high relative volume, and they'll almost always require a low float because initially when that move first starts, The only way a stock is going to all of a sudden spike up 30-40% on 15 or 20,000 shares of maybe initial volume is usually if the float is quite low. All right, so when we talk about float, under 50 million shares is best. Under 50 million shares is usually my cutoff, and under 10 million shares is best. And there is no too low, in my opinion. It's very rare to see stocks with floats of under 1 million shares. There's probably only a small handful on the market that are that low. I mean, we will see them occasionally, but it's pretty uncommon. So, that's not super typical, but if we did, I would just say, okay, well, that's a stock with a 400,000 share float. The supply is tiny. So if it does have a high level of demand, the imbalance between supply and demand could be really extreme. So again, I don't have an issue with the float being too low at any time. I don't have a sort of a minimum. I only have an upside maximum. So as we already talked about in the starter, the float is the number of shares of common stock available to trade. So with many small cap companies, there's a cycle of the float changing, beginning with the initial public offering. So we do the 10 million share IPO at $10 a share. We raise $100 million. And then we realize that we've spent it all and we need to raise more money. And this is very common, especially in the biotech space. So in the space of us trying to develop this incredible hair regrowth regimen or medication, whatever we call it, those companies can operate at a deficit for years and years and years before finally they start to, they get something that seems like it's starting to work. And often investors are willing to support their continued research and development, even though they're operating at a deficit, because they know the potential that if they do find this treatment, how much of a game changer that is for the company. So, from a balance sheet perspective, some of these small cap stocks, you will see that they do have a deficit, they do have debt, they do not have cash to keep running for another 12 months. And so we could understand that after that initial public offering, there is a high likelihood that they will have to raise more capital. And they can raise more capital in a number of different ways that we'll talk about in just a moment. So the three ways that the float can change from that 10 million share initial public offering, which is just an example, because an initial public offering can be any number of shares. It could be a billion, it could be 100 million, but we're just using 10 million as an example. So from that 10 million share IPO that Warrior Trading is doing to develop Uncle Steve's magical hair rejuvenation treatment, from that point forward, we could do a share buyback. So this is something that GameStop actually did, I believe, last year. They bought back shares on the open market. Now, sometimes a company will do this when they really believe in themselves. They have cash on hand and they think, well, no better place to put it than, right into our own stock price. However, there is some criticism about how share buybacks can sort of manipulate, and I use this in quotes because that's the criticism that we sometimes hear in the news, financial news networks, that it can manipulate the price because what they're essentially doing is they're buying stock on the open market, which just the buying itself will make the stock price maybe go up a little bit. But then the fact that they're reducing the outstanding shares available, they're reducing the float goes down on a share buyback. Therefore, the value of each share and the earnings per share will be higher because the float's going down. So, but in any case, companies that do IPOs and then do secondary offerings, they're freely available to sell shares on the market. So in this current economy, they're also able to buy back shares if they'd like. So a share buyback has the effect of reducing the float. So if our company drops to 20 cents a share, we might say, all right, we're going to buy back 2 million shares because we IPO'd at 10. Now we're at $2. We can afford to do the share buyback. So we do a share buyback, and then maybe we do that because we believe in the future of the company. We have noticed, Uncle Steve starting to, his eyebrows are getting really thick. So we've got to be onto something. I don't know. It's not really what we were going for, but hey, it's better than nothing. So we think the price of our stock is going to go up, and so we decided to put our money back into the company. So a buyback has the effect of reducing the float. All right. Now a secondary offering, when we realized that actually, growing eyebrows was one of many terrible side effects of our regimen, and it's actually going very poorly. We need to raise some more money. That's when we'll file that shelf registration and we'll raise more money on the open market. And there's different ways you can do a secondary offering. A secondary offering can be conducted by actually selling right onto the open market. And so if you're selling right onto the open market, I mean, if you have a stock that, and it could be any stock, but if you have a stock that, like GameStop, for instance, today is this 19 million shares of volume, and let's say they decide to do a secondary offering and sell 2 million shares onto the open market, just hitting that sell button, 2 million shares, they're just, or 200,000 at a time, whatever it is, they're just selling a lot of shares onto the open market. So when companies do direct offerings, we will often see really big sell orders going through. We will see big sellers on the ask, and we'll think, okay, if they have an S3 shelf registration, there is a possibility here that this is what's going on. Now, it's also possible that someone else is trying to sell, but we know that's a risk. Secondary offering can also be done as a private placement to an investor. So a intermediary, which is usually like a big bank, will put together, the investor to the company. So, let's say, I don't know, Bill Ackman says, hey, I want to invest in this. My hair's starting to thin. I'm pretty worried about how that's going to, work for my future. So I'm willing to invest $5 million, but here's the deal. Your stock is currently trading at $5 a share. I want those shares at $2.50. And we say, all right, well, we can't do $2.50, but we'll do $3.50. So let's just say we sell him $5 million worth of stock at $3.50. That's considered a private placement. He gets it actually below the current trading price, right? So the headline will be private placement at $3.50 to, so and so and so. And that has the effect of scaring all the traders that are currently holding the stock, because that price is so much lower than the current trading price. That person just got a big discount. And so a private placement that is significantly below the current price is going to be a problem. And secondary offerings often are structured in that way, and often they are below the current price because that investor wants to feel like they have a little bit of a cushion, and they can, if they need to sell their shares on the open market, not get, hosed. And then the third way the float can change. So secondary offering, selling more shares, increases the float. So the share goes up. And then stock splits. Well, a traditional stock split, like what happens with Apple or Tesla, price gets too high and they split the stock. Every time they do it, the float and the shares go up. So more and more and more. Whereas a reverse split, when a company's at 20 cents and then does that reverse split, as we talked about yesterday or in the last class, that has the effect of reducing the float. And so those are the type of stock splits, which is called a reverse split, that we will be looking at closely and talking about it as a specific form of catalyst. Usually just the news that a company's doing a reverse split isn't enough for us to start buying it. However, shortly after a reverse split takes effect, it's also very common for these types of companies to then put out good headlines. And to the extent that some of these companies will utilize different strategies to try to get their stock price back up, I'm sure they consult with legal people and also people that really understand the ins and outs of the market, because the person behind the scenes that's the CEO of a biotech company might not know the market even as well as some of us know the market. Not to mention how someone at Goldman Sachs or one of these big firms who's been doing this for 30 years knows the market. So they are going to be able to kind of probably strategize a little bit of what their goals are in terms of, okay, we need to put out some good headlines, we need to do some good things, we need to start getting the stock price turned around, and so a reverse split, then some headlines, that can get things going in the right direction. So the small cap cycle that we see a lot is beginning with the initial public offering and selling shares onto the open market. Now, I will say that an initial public offering is not the only way a stock can go public. A stock can also go public through a reverse merger into a publicly traded company. So there are some publicly traded companies that are essentially shell companies that can be purchased and then merged into the company that wants to go public, and through that the company goes public. So it's not always through an IPO, but let's just say, for the sake of this slide, we begin with the initial public offering of selling shares onto the open market, or acquiring a shell company that has very low stock price and going public there. So example, 10 million share IPO at $10 raises 100 million bucks. Then we file a shelf registration, which is the S3 form we talked about in our SEC filings in the Warrior Starter course. So we file a shelf registration to sell 50 million more shares on the open market, and it expires in 3 years. We do a $5 million secondary offering at $5. So 5 million shares at $5 raises $25 million. The stock drops to 5, the price of the offering. The float is now 15 million shares. It's increased because we sold 5 more. Then we do a 10 million share secondary offering at $2 and raise another 20 million. The stock drops to $2. The float's now 25 million shares, and the company's now raised 100 plus 25 plus 20 is $145 million. The stock drops to 50 cents over the next 6 months. It's no longer in compliance with the exchange minimum price of $1. The company performs a 10-to-1 reverse split. The stock opens at $5. The float's now 2.5 million shares, right? It's a tenth of what it was prior to the split. The company releases great news, and now with a low float and good news, the stock spikes to $10 a share. The company does another 5 million share secondary offering at $7, and this is in accordance with the S3, which is still valid. They raise another $35 million, and the float now goes down to 7.5, and now they've raised $180 million. And this is something that we see happen again and again and again. It's a combination of secondary offerings, reverse splits, secondary offerings, reverse splits, and of course news headlines coming out in between. So we can check to see whether a stock has a shelf registration directly on, this is the SEC website and their EDGAR, I think this is, I don't know, but in any case, this is the search area where you can search for stocks. But a lot of us use this website called BAM SEC because it's a little bit easier to use. And anyway, so we could go in here and we could look for a shelf registration. Let's see, BLPH. So this one has an S3 shelf registration right here. All right, so this is an example of the shelf registration, and in this case, they're reserving the right to raise up to $150 million, and they can sell, I guess, as many shares as needed to meet that number. All right, so when we see that S3 or an S3A, which is an amended S3, that would be something to take note of. And yes, special acquisition companies are essentially another form of a merger to bring a company public. So that's a very similar way to bring a company onto the public market without going through the process of an IPO. And one of the other things that's certainly, so Bill Ackman was talking, he's obviously big hedge fund manager, Pershing Square, I think, or Pershing Capital, what is it? Bill Ackman, Pershing, let's see, Pershing Square Capital Management. So I was right, anyway, on both, either way. So anyways, and so, Wikipedia says he's worth $2 billion, not bad, pretty good. So he had an interview where he was talking about Uber and how Uber, he wanted Uber to do a special acquisition with them. So he wanted to take Uber public through a SPAC. And he was sort of the mindset that, listen, we can tell Uber, we're going to give them this much money. We'll give them this much money, and this is how much they want to raise. And he was in the mindset that he could negotiate better numbers for them and hard numbers up front than the risk of the IPO, which is, a little bit more subject to the underwriters and what then retail traders are and some institutional traders are willing to pay. So there's different ways that a company can approach this, but Uber decided to do a traditional IPO. So Form S-3 outlines the details of the shelf registration, but it always has a placeholder here of, I guess, the amount of shares. They usually reserve the price of how much they'll raise, not, I guess, how many shares typically. But in any case, however you interpret it, this is what we would commonly see as the S-3. So the breaking news of a secondary offering. Most secondary offerings are announced as breaking news pre-market or after hours, although occasionally we will see them announced during regular trading hours, and usually that's not a good sign. So this is a stock, AKER, that in the morning had great news. I believe it had good news on this day. Anyways, it squeezes from $3 all the way up to $5, drops down, rips back up, and then right here, at whatever this was, 1 o'clock, announces 4.8 million registered direct offering. So the headline here is that AKER has announced that it has entered into a definitive agreement with several institutional accredited investors for the purchase and sale of 1.36 million shares of the company's common stock at a purchase price of $3.53. Well, stock's trading up here at $5, right? And so that nets the company $4.8 million, and H.C. Wainwright is acting as an exclusive placement agent for the offering. Gross proceeds are expected to be, $4.8 million. All right. So here's another one. UAVS, all of a sudden, boom, secondary offering, price drops from $3 down to $1.25. Here's another one, AIKI, secondary offering, boom, price drops from $1.80 down to 80 cents. Here's another one, secondary offering. And notice these are in the afternoon. Price drops here, 480, goes down to 320. Secondary offering. Now, the initial drop here usually is algorithmic trading. So it's those high frequency trading algorithms that do pick up the headline and immediately just execute short orders against it. And there we have that drop. So AYRO announces $15 million direct offering. So again, this is a direct offering with several institutional and accredited investors for the purchase and sale of shares of the company's common stock at $4.75 a share. It was trading at like $7.50 before all of a sudden that news hit the news wire and it dropped. So that's a big haircut off the high. Gross proceeds of $15 million. So that's all in accordance with the S3. So while it's certainly a risk, I suppose, knowing you're trading a stock that does have a shelf registration, for every time you see a stock that does go from $6 to $5, there are so many others that we then see make just continued moves to the upside. Sometimes even ones that actually have shelf registrations. And so you think, boy, this would be such a smart time for them to be raising money, but they're for whatever reason, we don't always know why, choosing not to. So DGLY, a stock here that squeezed from $2 to $20 in a matter of days, while some short sellers eagerly took positions, praying and hoping for a secondary offering, and then a drop. Next thing you know, the stock's up 500, 700, 800, 1,000%. And this is where you start to get that short squeeze. This is another one on VLTC. This continuation from 2 up to 20. And these are times where you think, boy, the company, that you would think that they'll file a shelf registration if they don't already have one, which is when they file one, that can be sometimes the getting the ball rolling, that you're like, uh-oh, they filed a shelf registration, we know something's coming, and then they keep going higher. Well, GameStop actually has a shelf registration right now. And look, this has gone from $19 to $500 a share, 483 regular trading hours. The shelf registration is over here. It says it's an automatic shelf registration that was filed. And so, it's sitting right here. And people can clearly see this. And so it's interesting to me why some companies will, I guess, utilize these opportunities to do very, very quick, direct offerings, and others just sort of hold off on it. And so that's a confusing thing for a short seller who is shorting purely with the expectation that the fundamentals of this company aren't good. And that's the thing, just on a quick tangent, short sellers who aggressively are betting against companies, when they look at the balance sheet and they say, listen, this company, the balance sheet is terrible, it's a mess. They're not always wrong. A lot of times they're right that these companies are not in great financial standing. And yet, the technicals in the short term can dramatically overpower the true fundamentals. And you can have this divergence, this disconnect between the true value of the company, not just, the book value, which we've talked about in the starter, meaning that the actual value of all their assets minus their liabilities, so the value of their property and their inventory and everything else, equipment, etc., and then the actual stock price. And so here we have a huge divergence where GME, this is not a $265 a share company based on what any financial analyst would say after looking at the books. But it is nonetheless trading at this level here. And it's off about 50% off the highs. And when it was trading at 500, it wasn't a $500 a share company based on its true value. And so I suppose the question of, isn't the value always just right here? This is actually the value. What are you talking about that that's not the value? This is literally the value of the company right now. That's true. That is literally true, that this is the value. It is a $265 a share company right now. That doesn't really make sense given its fundamentals. And so we would say that this is a company that right now is overvalued. But stocks and companies can be overvalued for long periods of time. And then the question, if you're a short seller, is how long can you hold? So with any of these types of moves, when you start to see a stock making a move like that, even if there is a shelf registration, it doesn't necessarily mean that I'm not going to trade it. So here's a stock in one day from $1.39 to $5.98, a 400% squeeze. This would be a perfectly reasonable time for the company to do a direct offering, after the stock's up this much. And sometimes they will, and sometimes they won't. And, we don't know. And if we did know, you would have insider information, you wouldn't be able to act on it, right? So, we never really know what's going to happen. So I just focus on trading the technicals. And I do try to be careful trading stocks later in the day that I believe are at risk of doing a direct offering, a secondary offering, because usually those headlines do come later in the day when they come during regular trading hours, or they come either pre-market or after hours. So it is something certainly to be cautious about when you think about, overstaying your welcome and trading later and later and later into the morning. So the low float potential. Often these stocks have gone through the cycle of the IPO, the secondary offering, the reverse split, and it's often following a reverse split when the float has been dramatically reduced, that the company will, release this positive news. And whether that's a strategy on their part, that they know positive news is coming out, so let's do the reverse split so people see that we're a $3 stock, not a 30-cent stock. We'll be therefore more popular among regular traders. The flow's lower, therefore that news might have a stronger effect on the stock. We don't know, but in any case, it's a very common pattern. Reverse split, positive news coming out, suddenly the stock surges up 100, 200, 300% or more, and traders are rushing for an opportunity to catch a piece of the action. So for this reason, I prefer to look for stocks with floats of under 10 million shares with breaking news today. And I often will check to see if they've recently done a reverse split. And I won't really check their S3 shelf registration status since I'm only planning on doing quick day trades, usually between 9:30 and 10:30 in the morning. And usually on the day they put out news, if they put out news at 9 a.m. or 8 a.m., they're usually not going to put out news of a secondary offering 30 minutes later. Usually, if it's going to be that same day, it's going to be later in the afternoon. So I typically feel like I've got a window where I can focus on trading it. So it's not really part of my process to check the shelf registrations or to check to see if there is one on every single stock on the Gap scanner. You could, just as a practice or a habit if you wanted to, but it's just not something that I do. So the low float potential, which is sort of item one on the strong stock, the characteristics of a strong stock. that one is important. It's probably the one that I have there first because ultimately the float usually is one of the more important components to a stock having what I would consider to be the potential to make that 20-30% intraday move. So when a trader says, "Hey Ross, have you checked out, the chart on GLD?" And I'm like, "GLD? You mean gold?" No, I'm not checking out the chart on gold. This doesn't meet our criteria in any way. This is just so. Have you checked the chart on Bank of America? No, I'm not going to, because this just is so far outside. Even if it has higher relative volume today, the float I just know is just not going to make it worth trading. So the first sort of most important criteria is float. There are times you will see me trade a stock like GME that has a float of 50 million shares. And if GME was at 60 million or 70 or even 90 million, I probably still would have traded it. There are some times where I've traded stocks that do have larger floats. ACB, Aurora Cannabis, was one of them. This one, the float on this stock is actually, I want to say 184 million shares. So this is definitely a higher float. But in this move here, this was, this went from $5 to $15 a share. So it made a really big move, and it did the same thing back here. And note how close that was, in this case, actually to a split, which is kind of interesting. So in any case, this to me was worth trading, but the float was definitely a bit on the higher side. So float is first, and then the second is the high relative volume. And so since ACB had extremely high relative volume, that was able to overpower the fact that the float was a little on the higher side. So ultimately it is, on the seesaw, who's heavier. And if you have a very low float, it doesn't take as much high relative volume demand to, create that imbalance. If you have a stock that's a little bit heavier in float, like ACB or maybe like GME, GameStop, it's going to take a little bit more weight, but it doesn't mean it can't happen. And it's because sometimes it can, certainly in the case of GME, but also ACB. So the high relative volume, it's the result of a surge in demand. When you have high demand, it results in high relative volume. A surge in demand only creates big moves, though, when there's a limited level of supply, when we have that imbalance. You could have, and I guess it depends. If you're going to say something is truly surging in demand, if anything is surging in demand by, 50 times above average, probably regardless of the float, 50 times above average is going to create a pretty big move in the stock. But it's more likely to see 50 times above average or something astronomical like that on a stock that generally trades on very, very light volume and is generally not looked at by a lot of traders, and then all of a sudden comes up with this catalyst. Then something like Ford or Bank of America that generally trade on millions and millions of shares a day, which means, 50 times above average would be like, almost unthinkable amount of volume. So if a stock is gapping up at least 5% with at least 10,000 shares of pre-market volume, it will often have high relative volume on that day. Now, Bank of America is not going to gap up 5% on 10,000 shares. Bank of America might gap up 5%, but it'll be on a lot more volume. But generally, if it's up at least 5% with at least 10,000 shares, just as a minimum, that stock will typically have above average volume on that day, high relative volume, because those are the early indicators. So one of our techniques will be to look for anything up at least 5% with at least 10,000 shares of volume, just at a bare minimum. And of course, if there's something that's up 30% with 3 million shares of volume, we would look at that before something up only 5% with only 10,000 shares, but we'll sort those from leading gap and then we can also look at leading volume. So what makes a stock extreme? High relative volume is typically the result of a news catalyst, but sometimes it can be the result of a technical breakout. News catalysts can come in the form of earnings, breaking news, activist investors buying, FDA announcements, SEC announcements, pharmaceutical clinical trials, clinical studies, things like that. So our focus is trading the big days. And so when we look at a daily chart, you can usually look back and you say, that was a high volume day. That was a high volume day. That was a high volume day. Those are the type of days we'd want to be trading the stock. And you can generally draw a pretty close comparison to those types of days having big candles. Not always, but usually. And in this case, these are big candles that are gapping. So we could look at, you could call out any stock. ACB is the one that I have up here. But, ACB, these are days that we certainly would have been trading it. And those are the highest volume days that this stock basically ever had, right down in here. GameStop, obviously, these are the days we've been trading it right in here. There were some high volume days back here, which are interesting, but these are the days we've been really focusing on it. Cost made a big move earlier this week, had a pretty big move back in December on high volume, but generally these are the highest volume days the stock has ever had. BPTH, this is a stock that we've traded over the years. Here we go. So high volume through there. All right, so the high volume obviously is a byproduct usually of the catalyst. So what comes first, the volume or the catalyst? Well, clearly it has to be the catalyst. So we focus on trading those big days. Those are the days when the stocks are trading at extremes. And we must, in my opinion, follow the volume around the market. So we are hunters of volatility and managers of risk as day traders. I think you heard me say that a little bit earlier in the course. Our job each day is to look for stocks that have that high relative volume. And we fortunately have the tools in our scanner right here to very quickly search for the top relative volume leaders in the entire market. And although occasionally we'll have one like this, it's kind of a false alert. For the most part, these are pretty right on. And these are the types of stocks that we certainly want to be trading. LODE actually was my biggest winner today. And that makes sense given that it's the highest relative volume leader in the market when you factor out this one that was, I think, a false alert. So if you focus on low, and this is a little, this might be a little controversial. Some people would probably have a different opinion on this, but I would say trading low volume stocks is asking for trouble. I will occasionally trade a low volume stock though. The times when I would occasionally trade a low volume stock would be if the stock has basically just started to pop up, I see a very clear catalyst, it's already moving on light volume, and that's telling me, wow, this stock really has the potential to move quickly. It's already up 50% on only 100,000 shares of volume. By the time it has 1 million shares, this thing could be up 500, 1,000%. So there are times where I will see something that has lighter volume, and because I catch it on my scanners, I'm thinking, well, it has lighter volume because I may be, one of the first people to see it because my scanners are tuned so finely. Let's see if there's an opportunity to find an entry. So there are some times where I will do that. However, the risk of trading low volume stocks, there's a couple. One is you can have bigger spreads and you can get a lot more slippage on your orders because there's not enough liquidity. More volume creates more liquidity. So it's easier to get in and out with bigger size. So I actually prefer stocks that have higher volume, but sometimes they start as a low volume stock that starts to make a big move. And then sometimes by the time the volume comes in, the big move has already happened and then they just kind of fade off that level, which is always disappointing when that's the case. So, for that reason, I will sometimes trade something with lower volume, but you always have to be careful and you want to make sure that that you're trading it because it's truly obvious. So the times I will be the most likely to trade something that is lower volume is when that stock is at the top of our gap scanner. Because if it's at the top of our gap scanner, then there's a good chance that millions of other traders are going to see that same stock. If it's on one of these scans, I may still look at it, but I've tuned these pretty finely, so this may not be something that other people see. And the reason it's important that other people are seeing it is because we want that volume to come in. We want this to have high relative volume, and we want it to have really good resolution on the pattern. And it's not going to have good resolution on the patterns if it doesn't have a lot of people looking at it, a lot of eyes on it. And so we look for ultimately slightly higher volume, definitely high relative volume, and usually higher total volume. So ultimately, stocks respect critical levels like volume weighted average price and the 200 moving average and patterns like bull flags and flat top breakouts because so many eyes are on them. So these patterns are sort of a self-fulfilling prophecy. The more people that see them, the more people that are watching that stock, the better they work. And so, to a certain extent, the more the more I educate people out there on YouTube and in these classes, and the more you share this language of the market with people you know, the more people collectively see these critical levels, and on each stock each day that is really in play, the language will be respected and the price action will be cleaner and more obvious. If you have a financial instrument, perhaps like Forex, where you have so many different people applying different types of charts. You have bar charts, you have line charts, you have the Heikin-Ashi charts, you might have some candlestick charts. You have so many different indicators. You have so many different kind of technical views of it that it starts to become just very congested, and you don't necessarily get those really clean breakouts that we seem to see on stocks generally with floats of under 100 million shares that have some type of clear catalyst. So, and this is a very low volume example. This is an extreme example, but on something like this, obviously the patterns are worthless. There's nothing here to trade. And the level 2 would be worthless to look at because there's anything you see is just some high frequency trading algorithms. Whereas this is the higher volume example. So this is low volume and low relative volume. So we must follow the volume, and maybe more clearly, I can go in on this slide and say we must follow the relative volume, and I'll underline the word relative because ultimately that's what's most important. So trading low volume and or low relative volume stocks is asking for trouble. That would probably be a clarification on this slide here. So I'm just making that on the PDF. So the high volume is certainly better. And then volume spiking at the time of entry is important. So when I'm jumping on something that's squeezing up, it's usually because in the moment I'm looking at it, I'm seeing it spiking. So I usually like to buy something that's spiking and as it squeezes up. So just as an example, this kind of squeeze here on costs, all of a sudden it breaks the volume weighted average price of 67 and starts really squeezing up and moving quickly. So as it's moving fast, I like to buy because I'm seeing clearly that a lot of volume is coming into it. That's what we want to see, that high volume coming in. So volume should be spiking at or around the time of entry. That's confirmation that the pattern that you were seeing, first candle make a new high or something like it, is being seen by other traders and is not just you, essentially. And I see just a couple of side questions there. So a question of what's my minimum daily volume? I don't have a minimum daily volume. So if a stock yesterday had only 10,000 shares, but today has high relative volume, as we saw on costs, this day, let's see. So this day had literally 120,000 shares of volume. The next day had 8.5 million. The next day had 34 million. So I don't care that the average daily volume on this was only maybe 100,000 shares a day. That doesn't matter. And in fact, the bigger the difference between the daily volume and today's volume, to be honest, the better. Because that's when you have the stocks that just come out of nowhere and they explode. So if we were really going to try to dial in on what creates some of these biggest moves, I would say it probably is stocks that have average daily volume of maybe less than 1 million shares, or even maybe less than 500,000 shares, or maybe even lower. I haven't really put a lot of thought into this, but just speaking out loud. And that then all of a sudden, with news or whatever it is, technical breakout, spike with that relative volume of 10 to 1 or higher. That kind of extreme whip is something that catches a lot of traders' attention, for sure. So I don't have a minimum daily volume for when I'm looking at previous days. When I'm looking at actually taking a trade, I don't really have a minimum either. And there are times where I have looked at a chart, I've seen a candle spiking up, and I've jumped in it and not even actually looked at the total volume on the day, because that's not one of the things that first sort of catches my eye. The things that usually are catching my eye when I'm pulling up a stock, I'm looking at the level 2, I'm looking at the 1 minute chart, and if I see it spiking up and I'm watching the level 2 and I'm seeing those orders go through, I might just punch it and jump in and then realize after the fact that, oh wow, there was only 100,000 shares of volume on the day when I took my first trade. Or maybe there was only 200,000, or maybe there was only 50,000. But it doesn't change the fact that I only took the trade because it was already up usually 25, 30, 40% or higher. It was already moving quickly. And so I'm jumping on the bandwagon. And that's, sort of back to what we talked about in the starter class, a little bit of that, mob mentality that the market often exhibits, where when one stock is hot, all of a sudden everyone flocks to it. And then that one cools off and another one picks up and everyone jumps to that one. And it's just sort of the emotion of the market. So the volume spiking at the time of entry is important. But again, the total volume, it's just that I would want to see green going through on the tape. I want to clearly see that there's orders going through, therefore other people are interested. If I pulled up a stock and there was literally no volume on it, I'm not going to be the first one to press the buy button. I would just wait for it to, I would just wait for more volume to come in. So, and just as a clarification there, volume, the definition of volume is the number of shares traded. And so we can see the volume right on the level 2, right here. We can see the volume in our time and sales window. So this is each individual transaction as it's going through. So right now, this is, as you can see, and I got to sort this again. I got to change the way this is sorting. But for some reason, it wasn't sorting correctly. So there we go. So you can see each one of these is an actual order that's going through. So if we were looking at a stock that, I don't know, is stronger or something like this right here, showing those bursts of green, something like that, a burst of green right about when I'm thinking is the breakout spot, that's all the confirmation I usually am going to need to want to punch that buy button, that burst of green. All right, number 4, a clean daily chart. So the clean daily chart should have gaps or windows. It should be above the 200 moving average, preferably. Again, there will be times where we would trade something below the 200, which might have been the case on ACB. But in that instance, it had a lot of room up to the 200. So let's see, that was back here, right? So, it did have that issue that the 200 was above it. The 200 EMA is in solid, the SMA is in dotted, the 100 EMA is in solid, the EMA, is in solid, the SMA is dotted. So, as it comes up, it's going to have resistance at these moving averages. It might have resistance at the 50. It might have resistance at the 150. Again, once it's above the 200, I just don't know people that use moving averages higher than that. So I think once it's above the 200, it's going to be more bullish. But we'd like to see a strong daily chart. We will talk more about those daily chart patterns as we get into a little bit more into this class, as I'm sure you know. We've already done a little bit of analysis on what constitutes a strong daily chart, how to draw the gaps and windows as we were going through the starter. But we're going to get into that in more detail. So the follow and continuation days, this is an expression that you'll hear me use, and it's when we're looking at a stock breaking the previous day's high. So this stock made a big move here on this day, and then on the next day, it broke through $10, which was the previous day's high. So that breakthrough previous day's high, that's what we would call continuation and or follow through, interchangeable expressions. If it's trading purely inside the previous day, it doesn't break the high and it doesn't break the low, we would call that an inside day. Usually, we don't really like to trade inside days because the volume is almost always lower. When stocks have an outside day, it breaks the previous day's high or a follow through day, that's going to be it's just going to draw in more new traders, and it's going to force some traders to bail out who are short, or bail out who are long, panic sell, etc. GME today actually broke to the downside below 250, which I was concerned about. So today is not an inside day for GME. It did break the low. Friday was an inside day. It was inside the previous day's high and low, right? So the high and low of this previous day, this isn't really the way I wanted to draw the candle, but I want to draw it like right on this red candle. So this was Thursday. The low was 112. The high was 483. And then Friday was an inside day because the price action was completely inside 483 and 112. Today has broken the low of the previous day of 250, which is a bit bearish. But this could set up a bull flag. technically, and then the first daily candle to make a new high and move back up, but it's not looking terrific with those red candles. LODE, so let's say the market closes right now. Tomorrow, we would say, all right, if it breaks through 417, that could be a continuation setup, a break through the previous day's high. And if it stays between 417 high and 205 low, then tomorrow would be an inside day. So again, usually we don't trade inside days. I will sometimes if the relative volume is still pretty high and the stock is still pretty volatile, which was the case on GME today. But inside days usually are not going to be as easy to trade as continuation follow-through days or simply the first day of the big move. And then for a stock to be strong, we like to see some form of catalyst, right? So when we're talking about different types of catalysts, and we're going to talk about these a little bit more here in Chapter 3, Part 2 under building a watch list. But we want to see that the stock has a reason to move. Now, if it's up 50, 100% with no news, well, we're going to interpret that this, therefore, is just, I guess, a technical breakout, maybe a short squeeze. Remember that stocks that have high levels of short interest can, if they start popping up, can start to force short sellers to cover, as we saw with GME, and create that squeeze. But we have the risk that, number one, some people are going to look at it and say, I'm not trading this, it has no news. Some people are just going to draw kind of a hard rule, no news, no trades. Now, I don't draw that hard rule, but the reason someone might draw a hard rule like that is because one time they were in a stock halted that had no news. It was halted by the exchange. The company came out and said, yeah, we've got no material news to account for this move in our stock price. And then the stock dropped by 50%. Now, I've been genuinely concerned trading GME that I would have the terrible misfortune of taking a really big position on it. And, today my biggest position on GME was about $1.8 million. And, on that position I made 40,000. And then on the next position, I took the same size of 1.8 million and I lost 60,000. So I'm down 17. But God forbid, in that moment, just after I pressed the buy button, it got halted by the exchange and it reopens 50% lower. I mean, I'm talking about a potential $1 million loss, the biggest loss I've ever had. And, I'm at a point where I know that I could recover from that financially, but it's something that makes me nervous, and it makes me nervous about overstaying my welcome on a stock that's up that much with no news. But, GME hasn't gotten halted yet, so my kind of opinion on it is if it hasn't gotten halted yet, I guess it probably won't. They're just letting it sort of trade its way through. But it's a scary thought. And so that fear will certainly be alleviated by focusing on a stock that actually has news. Now, a stock can have news, but if it's up 800, 900, 1100, 1200%, then you could come back to the area of risk that the exchange says, well, hold up. This is too much. We're going to halt it. We're going to make you respond to it. And they would have the same response, which is that there's no news that hasn't been released that is accounting for this move. The news is that we hired a new CEO and the stock's up 800%. I don't know. I guess people really like that move. But just be mindful of that risk. So generally, a catalyst is preferable. And then number 6, former runners, and being mindful of that kind of mob mentality or herd mentality in the market. And usually wanting to trade the stocks that other people are also watching, because that's where you'll see the cleanest follow through and the best action. So stocks that have a history of making big moves, which is, typically in the last 6 months or so. We know when a new catalyst comes out, things can get wild. So when we talk about former Momo stocks, again, you think about the first day that stock made the big move, the big move that really opened up. It wasn't a former Momo stock at that time. It was a stock likely no name, that no one really thought much about, and then all of a sudden it made a huge move, likely trapping early short sellers, and it just did something absolutely incredible. So that's a reminder that we don't always have to look for former Momo stocks for those home run trades, but to look for the one stock that could make a really big move because it meets the other criteria of what would create a Momo stock. The low float, maybe the recent reverse split, a decent daily chart, perhaps very low relative volume, very low total volume on the daily, and then today, very, very high relative volume, so a big ratio kind of imbalance there, which might even be something at some point that I'd look into adding as a column on our scanners the ratio of daily volume. I mean, I guess ultimately that is what relative volume kind of does. You never see relative volume of 50 or 100 unless you had really low daily total volume. But sometimes it's, I don't know, it might be easier to be able to quantify what's the average daily volume of this stock. Anyways, I'm thinking out loud. So these are, again, the example of the former runner, former Momo stock. And always remember, what goes up comes back down. So while this made an awesome move from 4 up to 33, you want to try to not be the one caught, quote, holding the bag. And that's when you're starting to play hot potato. And that's what people are certainly concerned about with GME and retail investors, that, who's going to be the last person who bought and the person who's in at the very top. And then that's where you start getting that rapid panic sell-off as people just unwind the position and bail out. And although we did have some panic on it today, it's holding up relatively well. So I don't know. But in any case, just be mindful about that. And then that is a return back to risk management. So stock selection as a secondary form of risk management. If you choose to trade stocks up 400, 500% with no news, while they may be the right stocks to trade for a number of reasons, and they may be volatile and they may provide good opportunities, you are certainly going to be increasing your risk on those types of stocks. And if you don't have the risk tolerance or account size to recover from kind of worst case scenario, those may be ones where you just have to say, listen, I wish I could, but I just can't, and steer clear and wait for better opportunities. So some of the steps you can take today to get better at stock selection: only trading stocks with high relative volume or that are on the daily gap scanner, only trading stocks above $1.50, avoiding penny stocks and OTC stocks, being very cautious trading stocks without breaking news, and be very cautious trading stocks that are running into moving averages or have bad daily charts. So that could be sort of a quick checklist. You could also add price price below 20 and add float, preferably below 10 to that list. So, doing your checklist each day as you're looking at your stocks to trade. And with that, let's continue on with chapter 3 and go into part 2.